So there's sort of three different types of stock selection on a very broad basis. So one is very passive, in that what you're doing is you're actually measuring or identifying the inputs correctly or more correctly than your competitors. The second is by actually managing the property better than your competitors. And then the third is simply knowing more than your competitors. So let's bear those three in mind, and then let's just go through. So firstly, the current rental value. So this is basically the first thing you're going to do in any asset appraisal, any cash flow. So what you're essentially doing is saying, what I want to do is I want to spot where there's a property where I can let it for more than everybody else thinks they can achieve. Because if you can let the property for more, you're going to achieve a higher return. So here we're very much, it's an information thing. Can you actually spot properties that are under rented? Rental growth is a little bit more active. So here you want to actually be projecting forward. So can you identify properties which have got superior rental growth prospects to other properties or to what other investors think? So a lot of emphasis is often put on rental growth, but I would argue that you should very much be wary of what the current rental value is, because there's a high degree of uncertainty as to that number. And in today's market, when you've got retail, when the rent is very, the rental value is very, very uncertain, nobody really knows what the rental values are, I would suggest that that is a massive, massive uncertainty. So then we've got our vacancies. So remember, our vacancies were driven by tenant rollover rates, by tenant default rates, and vacancy periods. So if you can estimate those better than your rivals, then you can achieve superior returns on your stock. So it might be that you're better at estimating the default risk, you're better at estimating the letting period, or you can identify properties which are more likely to renew their lease or less likely to exercise their break than your rivals think. I do remember a horror story from my past where an asset was acquired on the basis that they wouldn't exercise a break, and that calculation was based on the fact that the property was very unique, so it was assumed that the occupier wouldn't want to leave such a unique property. You guessed it, the property was acquired and the tenant did exercise the break, so that property performed very, very badly indeed. So actually that estimate was unfortunately completely incorrect. So that's an area for the vacancies. Irrecoverable costs. Now, you should have a good feel for what irrecoverable costs are, but they can be underestimated. And the other thing is that if you've got better managers or better management skills, you can actually keep these lower than your competitors. So one way of achieving higher stock returns is simply to manage them better than your competitors. So you can be neutral on everything else, but because you lose, 25 basis points to costs and your competitors lose 40 basis points to costs, you will outperform by 0.15% per annum simply through better management, and that would be regarded as stock selection. CapEx, this is a far bigger amount, and it's been well flagged over the years that this is quite regularly completely underestimated by investors. They just fail to take account for how expensive assets are to actually maintain. Now, normally people talk about offices and how capital costs, which is a form of obsolescence, is underestimated. Right now in the market, we've got an even shinier example, which are shopping centres. Shopping centres are very, very expensive assets to maintain. So you've got a high degree of CapEx. If your rents are falling and your CapEx is still the same because you need to keep the asset in lettable condition, then you're going to have a horrendous performance. So that's what's going on at the moment in shopping centres. Again, if you're better at managing your properties and managing that obsolescence, you can keep those capital costs lower. So we've already mentioned about the discount rate being specific to the investor, but also you can get the situation where the market simply applies, a much higher risk premium to certain properties than perhaps is justified. So if you can spot that, then you can deliver superior stock selection or risk-adjusted returns. Transparency is a very interesting one, though. If you simply know more than other investors, then of course your risk is much lower. So this is a really good argument for getting agglomeration benefits, being specialists in markets, because you can build up that knowledge and you can therefore basically generate a higher return through stock selection and also have that at lower risk because of the transparency.